G'day, guys, and welcome back to another Catapult Wealth Market Update. Today, we have the pleasure and honour of having Jamie Nicol. He is the Chief Investment Officer of DNR Capital. I've got about 27 years in the industry, I believe, and those guys are up in Brisbane. How's Brisbane, Jamie? How's it all going over there?
Yeah, well, it's relatively back to normal, except, as I was saying, we don't have any tourists. Kept the borders shut, so it's all a bit surreal as it has been for everybody. So I'm looking forward to things returning to normal, and so I can go travelling again.
We did actually invite James to come to Adelaide to do this video, but wasn't keen on getting locked out here. But no, I think it's interesting how the markets have bounced back recently, very recently. The Omicron stuff sort of came and scared the bejeebers out of everybody. But now the market seems to be, okay, it seems like the actual effects of Omicron aren't that bad. And even though it's highly transmissible, it's more the doctors, the hospitals and all that sort of clogging up that people are worried about. But what are your views, Jamie, on 2022 in terms of, in the light of what we've got, the US Fed bringing forward tapering and all the things that are going on? What do you think 22's got in store for us?
I think it'd be a more volatile year. That this year was a very benign year for markets, great year for markets, and it steadily went up on the back of very low interest rates. Of course, if the Fed starts to lift interest rates, I think that'll drive a bit more uncertainty for markets because people will be worried about whether lifting rates too quickly will dampen the economy. I still think the potential for the economy to be quite strong, though, and that'll give room for the Fed to lift rates. So one of the things that I think is difficult to grasp in some respects is that what might be good for the economy may not be that good for markets, because if Omicron ends up being a sort of fairly benign and allows economies to return to normal, Chinese economy gets going again as they start to stimulate it, I mean, that could be quite good for demand. And the stronger we have demand, the stronger we have growth, well, that continues to put this inflationary pressure into the economy, which means the Fed will have to lift interest rates. And low rates have been so helpful for markets over the last few years that I think certain segments of the market would struggle under that scenario. And I'm sure we'd see a little bit of volatility. And that could present opportunities as well. But I do think that would end up being a little bit more challenging, even though I think for the economy it would actually be quite a good thing.
Yeah, we're seeing a bit of a difference in terms of pricing for these potential interest rate rises. I mean, the bond markets have very much seemed to have priced it in. Energy markets seem to be very wary of Omicron, and I think that perhaps the equity markets have gotten, are ignoring it a little bit too early. But it's certainly very uneven. But the whole pricing in thing, it seems like there's quite a dispersion between the two. Don't you agree?
Yeah, we actually think the market's is quite complacent about inflation, and I think it's because we've had such a long period now of inflation falling and interest rates falling that people can't grasp the idea that could be shifting. And there's a lot of reasons why it might not. We just think it's quite odd that people are sort of pricing in growth stocks at very high levels, and bonds rates are still very low. We've still got negative real interest rates. So people don't seem to be willing to price much risk of that changing. And I would have thought, given the surging demand, given the level of fiscal stimulus, the level of money printing, that there's got to be some risk that inflation sticks a bit more. And certainly we think central banks are behind the curve a little bit. They're waiting to see wage inflation come through before they want to react. And by that stage, that's usually a lagging indicator for inflation. So it takes a while for it to feed through to wages. So we think, that's something to look out for. And I think there's going to be opportunities with that as well, because there's a whole lot of sectors that do well under a higher interest rate environment that have been lagging because they've had a very tough decade. And some of those sectors, like some of the financials, some of the material stocks, can do actually a bit better under that scenario. So it's a key thing to watch for, because as you say, there's such dispersion in the market between those that benefit from low interest rates and low inflation and those that don't. And that's where there can be quite an opportunity if that shifts.
Yeah, so when we talk about the local ASX market, we're dominated by banks and resources. And so we've got a situation where, historically, as interest rates rise, bank net interest margins are supposed to improve. But on the same side, we've seen iron ore fall off a cliff. And now there's a lot of speculation that maybe China is ramping up in terms of, we've heard about them stockpiling iron ore, and obviously they've got a bit of a slowing PMI, so they might kick it up. What's your view on iron ore from here?
Yeah, iron ore's reasonably tricky for all those reasons that you mentioned. It's always difficult to get a good line of sight on what's happening inside the Chinese economy. We don't think they'll do a major stimulus program like they've done in the past because they are wary of really ramping up their property market too hard. It's been a bit of a bubble, a lot of speculation in that property market. It does represent 20% of their GDP. So they're really trying to transition their economy away from over-reliance on property towards domestic consumption and some other areas of their economy, which will be a little less iron ore heavy. Nonetheless, they still don't want inflation to rise too much. Unemployment to rise too much. Social stability is very important in China. So given that you've had that slowdown in PMI and you've had iron ore prices halve from the top, we are starting to see them start to stimulate. And while they may not ramp it up like they did last time, we do think they'll continue to sort of steadily improve stimulus. And how quickly iron ore reacts to that, I'm not sure. But I would have thought over the course of the year, it will still be quite positive. And if we take a longer term picture, if we think of the biggest bullish argument for commodities, we think is the move towards zero carbon. I mean, our long-term future looks like it's heading towards a zero carbon future. That means we need a lot of copper, a lot of zinc, a lot of nickel, a lot of aluminium, a lot of iron ore. If we're going to build wind turbines, I mean, there's a lot of iron ore in all of that sort of expansion. If you're going to build hydrogen plants, it's a lot of iron ore. So there's incredible demand story longer term, and that might not all play out next year, but I think it's going to play out over the longer term. So I think the future looks pretty good for Australia from that perspective. I mean, we are the lucky country in some respects. I mean, I think one of the amazing stories is around coal because coal's going to get phased out. It's been such a key export sector for us, but it will get phased out, particularly thermal coal over time. But we'll be well placed to participate in hydrogen, or if it's nuclear, we'll be doing uranium. If it's renewables, we're very well placed on the renewable front. A lot of sun, a lot of good spots for wind. Surprisingly, there's not that many countries that are as well placed as us. So I think we will be well placed in this energy transition, and it's good to see that money starting to get spent in that area because I think don't want to be left too far behind as the world moves towards that.
So just to summarise, this next year, 2022, likely volatile, especially in a rising interest rate environment, potentially in the US. But long term, we've got the key thematic drivers that should still see strength, given iron ore is our number one export.
Yeah, and I think Australia's just well placed. Like if we do get the interest rates rising and inflation rising, it's probably not so good for NASDAQ and some of those winners over the last decade. But for the Australian market, as you say, dominated by financials, material stocks, they can actually do pretty well in that environment. And so that could be quite interesting for the Australian market.
Yeah, good. And so we've got the US rising interest rates. So that generally means that money flows to US bonds. But then we've got the iron ore piece on the other side. What's your view on what the Australian dollar might do against the USD?
Yeah, that's a tough question. Always currency is probably the hardest thing to get right. I mean, we're trading at about 70 cents. I think long-term average is probably 70, 75. So we're probably at the light end of a sort of long-term average. If iron ore picks up over the course of the year, then you would expect it to rise. So I'd probably expect a trading range from 65 if iron ore continues to weaken over the first quarter or so to up towards 80. That's probably what I'd expect.
That's a big margin.
Yeah, give myself room for error.
And just finally, so what do you like? What sectors are you liking, and what sectors are you sort of wary about going into 2022?
I talk about financials, but I'm actually not that bullish on banks because I think even though the banks will do a little better, possibly in some areas, it's still very competitive in mortgages. You've got a lot of new players coming in. They're competing very hard, and Australian mortgage earnings are very high globally. And I think with this competition coming in, but insurance sector, I think looks better. There's Macquarie Bank looks fantastic. Computer share, these stocks will do better in a high interest rate environment. Good market positions, market leaders. So I think other sectors I don't really think stand out other than sort of things we don't like. I think we're a little wary of the ultra high valuation stocks, with zero earnings, big revenue multiples that have gone up a long way over the last couple of years. I think there's a bit of speculative interest in some of those stocks that concerns me. But we're just trying to find individual stocks. We like stocks which have been affected by COVID because while I don't know whether things are going to return to normal in the next 3 months, I think inevitably we're heading that way. And so some stocks earnings can rise. Telcos, for example, like Telstra's probably lost $500 million because people aren't traveling overseas and global roaming. It's a defensive earnings stream, good yield. A lot of the sins of the past are behind them, and it's just a simple mobile business and an infrastructure story. You can find stories like that. Even CSL, it's a little bit more expensive, but CSL's had a tough COVID. People haven't been able to go to to deliver plasma, to deliver blood. That's caused some problems for them in the US of not having a product to sell. And so as things get back to normal, that should be good for them. So some opportunities like that on those COVID recovery stories look interesting as well.
Yeah, I think a perfect example of that is Sydney airports, right? So they fell off a cliff during COVID, but are we never going to fly again? Of course not. So just picking up some of these good, in normal times, good quality earners makes perfect sense.
Exactly. Yeah.
Beauty. Look, thank you very much for your time, Jamie. Really appreciate it. Jamie's one of the co-founders of Nicol or DNR Capital. So we really appreciate your time. And to all you out there watching, thank you for tuning in, and Merry Christmas to you all.